Hello, and welcome to Module 4 of Accounting Made Simple for Busy Business Owners. I'm Marie Gibson with Gibson & Associates, and I developed this program to help business owners learn to create, understand, and fine-tune their accounting system simply and effectively. In our previous modules, we discussed how we would track our income and expenses in separate categories or file folders. In an accounting system, these are called accounts, or in some software, they are called categories. We also discussed how we would separate those accounts into 5 types: our assets, our liabilities, equity, income, and expenses. And those 5 types should start sounding like music to your ears. You really do have this. Then we've also discussed how if we spend 15 minutes per week on organizing and reading our numbers, we wouldn't have to spend a full weekend or more at the end of the year. Our very first homework assignment for Module 1 was to actually think through the names of the file folders that we should have for an organizational structure. Our next homework was to organize those money in and money out transactions, those file folders, those accounts, into our 5 favorite types: assets, liabilities, equity, income, and expenses. And then our Module 3 homework, we looked at how we would combine those accounts in a spreadsheet format. And the first spreadsheet format that many are familiar with has 2 major sections, one area for incomes and the other area for expenses. This formatting process creates the basics of a profit and loss report, sometimes known as a P&L report, and some call it an income statement. I ask you to start on this report, even if it's just for 1 month, or maybe you could only do for 1 week, or you could do just your expenses, or just your income, or just your incomes for 1 month. A bite, a tiny bite, so that you have working knowledge of how your reports will be created. From our next little diagram in our handouts, you can see that the income statement is the report in the middle, which shows our incomes and expenses. After we subtract everything we paid for, our costs and our expenses from the monies that we've earned, the amount that is left over is called net income, or what we call our profit. Or if we spend more than we take in, then it's called a net loss. The word net comes from the meaning of the word sum, S-U-M, which means adding and subtracting. Now this report is one of the most business owners' favorite reports. It's the one that you rely on a lot. Now the income statement, the profit and loss, or P&L report, as it's called, that report is always created for a period of time. It's created for a week, a month, a quarter, or even a year. It includes income over time with expenses over that same exact time period. Now, this basic accounting principle is called matching. Matching simply means that however much money I earned during that month, then it took the corresponding expenses to earn those revenues. There is, of course, a more complex discussion of matching as we move further into another program. In addition to our P&L report is another report that is every bit as important and sometimes not created or referred to very much. It's called a balance sheet. It shows 3 types of accounts or categories on the report. It shows our assets, which is everything our business owns. It shows our liabilities, which are all of our debts, and then our equity. To keep this conversation simple, we might use a couple of examples. Let's take our car, perhaps costing $20,000. The loan is $18,000. So we pretty much know that you put $2,000 of your own money up. In addition to that, that part is your investment or your capital. Another example that some of you will relate to is a house. The house costs you $200,000. You put up $20,000 of your own money, so we know that the loan will then be $180,000. Business is exactly the same. Our balance sheet for business is exactly the same, and it's interesting that a few of our minds will wrestle with this idea. So let's look at it a little bit different. Think of all of our assets, add them up, and they're worth $50,000. And then let's say that we have debts, perhaps credit cards, perhaps loan, business loan. And then with simple math, we know what the equity or net worth is. So in this case, our assets are $50,000. We have debts of $10,000. Our equity or net worth is $40,000. Now, for those of you who are interested, we can have a brief conversation, a rabbit trail per se, about why and how a balance sheet works and how it's related to that algebraic formula of x plus y equals z. With the basic formula, we can switch the numbers from one side to the other, and if we don't know one of those numbers, we can usually solve for it. For those of you who are not interested, just remember the general concept, not the actual formula, right? So the general concept is if we take all of our business assets and we add them up, and then we subtract all of our debts, what's left over, that's the net worth or the equity of our business. Now that was a pretty hefty conversation in our learning video for this module, so let's take a quick break and come back for a wrap up of this conversation.